There's a great deal of uncertainty in the air given the Russia-Ukraine conflict. Investor philosophy tends to see established capital flying into what's deemed as safer assets, which includes instruments like bonds and gold, among other assets, when crisis hits. And there's a tendency for capital to fly out of assets deemed less safe, like emerging market equities and currencies. So what does the latest spectre of conflict in Eastern Europe, which could so easily become a bigger war, mean for emerging markets like South Africa? I'm joined by David Rees. He's the emerging markets economist at international asset management firm Schroders. Thank you very much, David, for joining us. Now, the Russia-Ukraine situation is a very fluid one, which could change for the positive or the worse very quickly. This is not a scenario that markets can ever really be comfortable with. So what should investors be doing in the interim?
Yes, it's very difficult, isn't it? Because we're in such a state of flux and everything, is changing by the hour practically. And I think the measures that have been put in place, sanctioning the Russian central bank and looking at excluding it from the SWIFT payment system, pretty severe. And so that uncertainty is going to roll on for some time. Now, as you would expect, you've seen quite a big reaction in Russian financial markets, so the ruble has sold off. And we've seen that ripple through emerging markets, as you said, during times of kind of extreme uncertainty. You tend to get what we call a flight to safety from risk assets to kind of safe havens. And we have seen that from emerging markets. For example, the rand is down 2% roughly against the dollar, at around 15.5 against the dollar. Mex peso is down about 1%. But actually, I would say those reactions are not as bad as they might have been, considering the seriousness of what's going on. But of course, the longer this runs on, the greater the risk of more capital flight, more flows to safe havens, and as you said, into the US Treasury market, into gold, and things like this.
Yeah. So what do you see as some of the key risks for emerging markets in the year 2022? We know the Russia-Ukraine conflict looms large and the implications that come from that. But generally speaking, obviously before this conflict, there will have been other factors driving emerging markets.
Yeah, so I think one of the key ones is obviously the hawkish pivot in central bank policy in developed markets. Particularly the Fed, where it's felt like by every press conference, Powell has been getting more and more hawkish, to the point where the market was pricing in a 50 basis point interest rate hike next month. I think that events in Russia and Ukraine and the sanctions and the kind of ripple through global markets mean that it's quite unlikely that the Fed is going to go that hard. But probably it is still going to be hiking interest rates this year because inflation in the US, we have got energy price rises there, food price rises. And of course, what we're seeing now with energy markets will exacerbate that. But you've actually really got a very strong labour market there, a very strong consumer, and that's been driving inflation as well and risks what we call second round dynamics of rapid wage growth. And so the Fed will be hiking interest rates and tightening policy and probably start shrinking its balance sheet. And historically, that's obviously been a difficult time in emerging markets when the Fed has been tightening. Now, we've been making the point for some time that actually this time around emerging markets look relatively solid because their external positions are in quite good shape after the crisis, and they've been raising interest rates, which has built some buffers. And I think that goes a long way to explain why a lot of emerging market currencies, for example, have taken recent events in their stride. But it's becoming quite a toxic cocktail, isn't it, of the Fed tightening. We've still got China in a slowdown and yet to really stabilize. And now we've got these political problems as well. So that's kind of like three pretty big risks at the moment.
Yeah. To what extent do you think the slow pace of vaccination in some emerging markets, particularly here on the African continent, is also going to impact or be a downer for those economies?
Absolutely, yeah. I mean, unfortunately, in Britain, for example, we've been able to grab hold of a lot of vaccines, roll them out and kind of more or less get the economies back on track along with some big stimulus measures. And in most emerging markets, that hasn't really been the case. And obviously, South Africa is a case in point. And so slow vaccination rollout and relatively small stimulus packages, and this has been a theme around a lot of emerging markets because the debt dynamics aren't in great shape with a lot of EMs, which meant that there isn't a lot of room to do big fiscal stimulus packages, and also it was challenging to get vaccine, procure them, and roll them out, and so that has meant that emerging market growth is generally lagged behind. And the more that it's lagged behind, the greater the risk of kind of some permanent scarring in these economies, and the kind of knocks down the future rate of growth, which was already quite weak in a lot of these economies.
David, thank you very much for your time there. David Rees, he's the emerging markets economist at Schroders.